All right, so this came out today, the other day, Vanguard stuff. And I'll just put the link right here. And this is going to be what I use on my, can I do it here? Don't ban me, bro. No doubt. No doubt. So this is the Vanguard, if I could put it on there. So there's a Vanguard thing that you can look at. So let's, wait, am I still on there or what? Yeah. All right, sweet. All right. So there's a lot more than just, I'm just looking at the impact on portfolios. And you can look at the whole thing. So we're going to, because there's a lot going on here. Economic outlook, impact on portfolios, client conversations. So what I want to do here is we're going to go to overview right there. For equities, high valuations and lower economic growth rates mean we expect lower returns over the next decade. For fixed income, lower interest rates and flatter yield curves are expected to weigh on returns for the foreseeable future. A consistent theme of persistent low inflation and low interest rates across the developed market economies emerging from our economic outlook supports our view of a lower return environment. The theme affects our outlook for bond yields and therefore future bond returns. I cannot tell you how many people don't get this. Bond yields and future bond returns. People are saying, well, last year my bonds was up 9%. Is going to give it back. I'll show you again how bonds work. It's the simplest thing in the world, man. And it's actually sad how many people are going to fall to the idea that they're going to get 9% rates of return on bonds. Just nuts. But anyway, this affect lower future bond. So right here, outlook for bond yields and therefore future bond returns are going to be low. Equity valuations and earnings growth and even a growth versus value debate. All right, so this right here is, you want to talk about clickbait. It's not clickbait, but I'm just saying probability of a 10% downturn in 2020 in the next 3 years. Now, this is clients rate for 2021. I'm not sure why they put this in here. So they had a probability. I don't know what that would be for 2019, 2020. That doesn't make sense. Probability corresponds to percentage of, I don't know why they're showing this for 2019 and 2020. Global equity market. Problem. Okay. Oh, I guess they're saying for the next 3 years. So 2019, 2020. I don't care what that is. All right. Even with the roller coaster equity rides, roller coaster ride equity markets have had this year, our outlook is remarkably similar to last year's. Our expectation for lower GDP, lower trend GDP, and its impact on corporate revenue growth, along with contraction in valuations, has led to a guarded outlook for global equities, which we expect to return 5 to 7%. So global equities, they expect to get about 6%. All right. That's top line over the next decade. So they're expecting global stocks to give you 6% over the next decade. We do not expect the trends that defined the last decade to persist. Namely, we expect equity markets outside the U.S. to outperform largely because of lower valuations and higher dividend yield. So they're thinking, so what that means is if they're expecting a 6% on average rate of return for the next 10 years in global equities, and they expect equity markets outside the U.S. to outperform because of lower valuations and higher dividend yields, it doesn't take rocket science to figure out what they think the U.S. economy is going to do, U.S. markets are going to do. Likewise, we are expecting value stocks to outperform growth over the next decade based on fundamental assessment. A word of caution, given a strong, if not uniform recovery in global equity prices, the risk of a sharp downturn defined as greater than 20% remains elevated. All right, so I don't know what this, but I just want to show you something right here. Global having a 10% downturn is that happens all the time. The average top to bottom on any given year is 14%, man. So having a 10% downturn, that's freaking nothing. That's a drop in the bucket. A 20% downturn is a bear market, and that happens about once every 5 years. All right, so we've had one this last year. We had that one. We had Q4 of 2018. The S&P was down 19.4, so not actually officially a bear market. May and June of 2015, we had like a 15% decline. And then July and August of 2011, we had about another 17% decline. So we've really only had one bear market since 2009. That's it. We've had a couple of close runs, but nothing other than the one we had, and that was so fast that I just tell you right there, man, that's not that's not normal. It's not, and that is a cause for concern. But anyway, so a 10% downturn, that's nothing, man. 20% downturn every 5 years. We've only had one, and that was only for 33 days this past year. So that is a cause for concern to some regard. All right, so fixed income's good. It's not looking good against the backdrop of lower yields. What's the let's take a look right now. What's the 10-year Treasury? I think it was above 1 now. 10-year Treasury is 1. Yeah, so the 10-year Treasury is 1.08. So you're getting 1% essentially to lock in money for government bonds for 10 years. That is not indicative of inflation, which is interesting because we did get a report today that inflation numbers were pretty high relative to previous. Higher than would be expected, which might be a one-off. I don't know. We'll have to see. But that was interesting. So with the 10-year Treasury at 1%, that's not a threat that people are jumping off a bridge because of inflation. The 30-year Treasury right now is at 1.8. So that's that's climbed. Let's see. It was down to March. It was down to 1.2. Yeah, 1.215. So March 6th of 2020, the 30-year Treasury was yielding only 1.215%. In fact, down July 31st is down at 1.198. So it's had a nice rise on yields, which means the opposite of prices. So your bonds just have got hammered over the last 6 months or so. Still low. I mean, a 30-year Treasury, locking up your money for 30 years, less than 2%. That's still ugly. Anyway, so the revised downward from last year's projections to basically 0.75% to 1.75. So that's their expectation for bonds. That's bonds across the board, not just government bonds. So basically, it's at 1.35. That's what they're saying. So their outlook for the next decade on bonds is 1.35, amigos. Expected returns for non-U.S. bonds are marginally lower than those for U.S. bonds, given the relatively lower yields in non-U.S. developed markets, which is why you shouldn't have any international bonds. It makes no sense to have any international bonds. Get the hell out of them. There's no benefit there. There's only risk and more risk and more risk. So there's no reason to own international bonds. We can make an argument for international stocks, but international bonds are a big fat nothing burger. Don't do it. Within the U.S. aggregate bond markets, investors are still expected to be fairly compensated for assuming credit risk, which is consistent with our expectation for broad U.S. Bonds outperforming treasuries by 1% on an annualized basis. So if we're going to get 1% on broad corporate bonds, more than 10-year treasury, basically you're going to get a double your yield on a 10-year treasury with a corporate bond. It's still 1% to 2%. Wow, that's fantastic. 2%. Well, I'm telling you that don't bank that yet, because I'm going to show you the negative here is coming down. While future returns for fixed income look low, the recent crisis has reaffirmed the diversification role they play. I'm not so sure about that, did it? The treasury market got killed too, man. So I'm not so sure that the diversification showed itself at all with bonds. I don't think it did. Certainly not international bonds. All right, so right here, return projection, U.S. equities. So we can see about 4.7% is what they're expecting. 4.7 on U.S. equities. But growth is 5.8. U.S. growth is 2.1. So you see a huge difference between what they're expecting on growth versus value. So, value is 5.8. Value stocks, high dividend yields, low PE ratios, low price to book. That's how you usually ascertain a value stock. VTV, that would be the value index that I own. My biggest holding by far is VTV. And let's just take a gander of what that guy's been doing. I really don't check, probably, I don't know, once every 2 weeks or something like that. VTV is at 123 right now, basically. Yeah, still got yield of 255. So VTV still looks pretty good in my opinion. I'm not sure what so that has jumped from 122 at the it's jumped about 20. I mean, hell, 20% in the last couple of months alone. So VTV looks pretty good. It looks like it had a nice little run. Let's look at VUG, which is the growth index. And that's kind of plugging along at hasn't really done much. Hasn't done badly, but just the last 3 months has definitely been a value. Value has outplayed growth by far in the last couple of months. And then VUG only has a yield of 0.66. So basically, there's a 400% more of a yield for VTV than there is for VUG. And I just the PE ratio on VTV, we can look at Vanguard to see here in just a second, but it's going to be ugly for VUG. Anyway, just going back to Vanguard, they're expecting we'll just say for simplicity, 5.5% rate of return for value stocks over the next 10 years, and essentially a 2% rate of return for growth stocks over the next 10 years. Take it for what it is. And so we're going to adjust these in the software for U.S. equities. On Right Capital, I adjust them every time Vanguard releases their new year thing. I change it, so we're going to adjust it to 4.7 for equities. Woo, that's going to be fun. I hate to do it, man, but I got it. All right, so now we got U.S. global equities. You're accounting for 8% without the U.S. That seems, I don't know. So I'm going to go with it. I'll put 8%. Man. So they're calling for 4.7 on U.S. stocks and almost, not quite double that, but significantly higher on global stocks. Well, I'm going to put it in the software. I mean, I go by what Vanguard says. That's pretty significant, man. What happened to this right here? We expect. All right, so let's see. Our global. Okay, so this is global equities, which consists of U.S. That's not ex-U.S. So just real quick, guys, if you guys are looking at stuff, global equities includes the U.S. unless it says ex-U.S. That means excluding the United States. So what's happening here is this could be kind of confusing if you're not conscious of this. They're saying global equity. So you might inherently think foreign equities explicitly. It's not. This is global with the U.S. So they're basically saying 6% a year for stocks across the board. That 6% a year will be comprised of 4.7 from U.S. stocks and basically 8% from global stock, from foreign stocks, essentially. And that's where they're getting their essentially 6%. Yeah. I might just I think what I'm just going to do, I'm just going to put 6% for U.S. stocks, for stocks, to be honest with you. I'll split the difference, just put 6% for stocks. There's no way. I mean, people want to say, well, this stock, that stock, this fund, that fund. There's no way. No one knows anything. A 6% rate of return for stocks sounds pretty safe for me. Right now, I got stocks at 6.5. So we're going to reduce our stocks by 0.5% from 6.5 to 6. All right, so just if you're in the Right Capital software, it might look uglier today than what it did last year because Vanguard had it 6.5. We're going to reduce it to 6. Their bonds are, oh man, that's, here we go, aggregate bonds. Jeez Louise. What's that, 1.25? Man, that's a pretty significant drop from what I'm using. I'm gonna do it, man. I change it every year. I gotta stay consistent. Woo, that's painful to see. So stocks are gonna drop from 6.5 to 6. Bonds are gonna drop from 2 to 1.25. Hey. Inflation though will drop from 2. I'm using 2 right now to what's that? 1.5. So that's a 1.45. So that's a saving grace. So before I was using it, so actually let me get my trusty calculator. I was using 6.5 on stocks minus 2% on inflation. That's 4% net. Now I'm using 6% on stocks minus 1.5 on inflation. That's that's 4.5% net. So because inflation is so low, you've increased your net rate of return actually. So that's good. So the top line returns are going to look ugly, but when we factor in inflation dropping significantly by 75 basis points, that's good, man. That's good. We'll see what the trustees report say for Social Security. I can almost assure you that's going to drop from 2.4 for cost of living adjustments to 2. I haven't seen the updated report yet. I don't think they produce that until March, I believe. And then we'll see what the trustees report says for Medicare. I got a sneaky suspicion that might be painful to witness, but we will see. But anyway, these will be going in here shortly. So we're going to change inflation. We're going to change U.S. stocks, and we're going to change bonds. It looks like it's going to net to you, though. It'll net you. It'll net benefit to you because inflation will be significantly reduced, even though stocks are kind of reduced and bonds are significantly reduced. It still will be. The bonds won't look. Bonds will be negative. The negative yield on bonds, yeah, right there, man. So if you take, 1.35, I guess, on your projections on bonds, we subtract out 1.45 on stocks. Yeah, so the bonds will give you a negative return. Stocks will increase your return net. Bonds will give you a lower return net because inflation is higher than your bond rate of return. And that's aggregate bonds. That's government bonds and corporate bonds as well. If you're only getting 2.5 to 3.5% on high yield corporate bonds, drop them. There's no reason to have high yield corporate bonds if you're only getting that, because you could get freaking dividend of VTV at 2.5 right alone with the upside of dividend stocks. So there's no reason to own junk bonds if you're only getting roughly 2.5. And I can get a 2.5% dividend on stocks. It doesn't make any sense. All right. That's interesting. So let's see what they say to help your clients. And again, you all have access to this if you want it, and you should. You should save it. You should download this and save it so you can refer back to it for future use. Prepare your clients for the changing economy. Your clients wonder how these factors of global economy, Sniffy Joe or Steely Joe, COVID-19. When it comes to global economy and markets, adopting a proactive approach, the Vanguard advocates a 3 A's behavioral coaching approach. Assess the situation. How you feeling, clients? You feeling okay? Address the situation. Explain to clients that worries about the global economy and the markets are common. They're common. And share resources that speak to their concerns. It may be helpful to help them focus on their long-term goals. Remind clients that 2 major elements of wise investing are knowing what they can and can't control. It's kind of like going to an AA meeting. Audit the engagements. Evaluate clients' behaviors, all right? Understand the importance of planning for the long term, and do clients opt to stay the course? Okay, whatever. Let's see their model portfolios. Let's see what their details on their model portfolios are. I got to log in. I got to register. I thought I was registered. Let's see if this. Shoot. Yeah. All right. All right. Okay. I'm sure we can find those. But anyway, so there you go, friends. Good stuff. So we'll see what you all think about that. CB says I have VDigX in my Roth. Yep, I do too. Not my Roth, but I do have that. Let's see. All right, let's keep looking. Southern California today, 75 degrees. Yeah, but then you got to deal with Governor Gruesome. Who wants to deal with that guy? Actually, I just talked to client the other day, and they've been in California for many moons. They love it there. They're going to live in a condo. They're not living high on the hog, and that's the thing. Other than you have no rights living in California. I mean, it's not the worst thing that ever happened. You know what I'm saying? I'll never step into California, but I don't blame them. They're like, look, we like we don't get too hot, we don't get too cold. They're going to put solar panels on their condo. That makes sense, man. So you don't have a huge need for heat, a huge need for AC. A couple of minutes from the beach. You're not paying much in income tax. That's not a bad deal. John Roberts is back. John Roberts, you're supposed to be taking care of Supreme Court stuff. So Justin says S&P versus NASDAQ long-term for young investor. I'd go with the S&P. Justin said he left VDIGS for SCHD. That's a Schwab dividend. VTI crew, raise up, raise the roof, VTI. What are my top 3 funds for Roth and for traditional IRAs? As I say all the time, if you're going to have REITs, you'd probably want those in a Roth for sure. If you're going to have any dividend funds, you want that in a Roth for sure. So I own VDIGX, I own VTV, which is my biggest holding, and I own VDIGX, VTV, and I own VTI. That's the total stock index, and VBK. Is it VBK? Yeah. So those are my 4 funds, and I got 100 shares of Exxon. I saw that Intel is tearing it up, man. We just talked about Intel the other day. I should have bought some of that puppy. I just totally forgot. Intel. Oh my God, Intel's up 7% today. Did you listen to me? I told you buy Intel. Oh my! Look at that! Look at that! Jags. Look at that. Damn, man. Intel was up 10, was at 46 December 22nd, and now it's at 57. So 10 divided by 46 is what? 10 divided by 46. You would have made 22% on your money in freaking, 3 weeks' time. You know why? Because I didn't buy it. If I would have bought that puppy, it would have gone down 22% in 3 weeks' time. You know it. Damn, let's tell me Cisco isn't tearing it up. What's the motivation behind Intel tearing it up? Cisco. Oh, cheese, Louise, and Swiss cheese. Yeah, Cisco. All right. Cisco hasn't done anything. Why? That's interesting. So Cisco hasn't done anything, but why is Intel tearing it up, man? And what the? Oh, they got CEO change. Is that what's going on? What's Exxon doing? My man Doug sent me an article on Exxon. Exxon's up 1% today. Damn, look at Exxon, boys. Everyone's saying, Scanlon, you're a big sucker for buying Exxon. That's up to $48. Ooh, Exxon's got PE of 62. I might have to offload that and just take my gains. Yeah, I might have to offload that. Just take my gains. A PE ratio of 62. That's too high. Still got a nice fat dividend yield, but I might just get out there where the going's good and buy some Cisco. All right. It's nice to actually make money in the stock market for once. I always lose, man. I'm such a loser when it comes to stocks. I should always just stay VTI and be done with it. Let's see.